Hello, thanks for joining me. This video is about asset-based mortgages or asset depletion loans. And so if you've never heard of that before, I'm going to take you through what that is and how you potentially could qualify for it or why it would benefit you. So an asset-based mortgage is one where you qualify using your liquid assets. And this is great where you have individuals who have high liquid assets but little income coming from a job, or if they have no job at all. This is a type of loan where you can qualify for a mortgage just purely based on your liquid assets. So there are really two ways in which this will work. But first I want to take you through what qualifies as liquid assets and what doesn't. So liquid assets would be your checking and savings accounts, any stocks you might have, and also 401k, but oftentimes the lenders will only let you use your 401k balance if you are at retirement age, and they might cap it at 70% of the balance. Okay, so you'd add up all of those accounts, and then you'd have a total, and then you'd subtract any other debt you might have. So let's say all of your liquid assets add up to $500,000, but you might have a $25,000 balance on your car loan, and you might have another $25,000 worth of credit card debt. Okay, so then that liquid asset balance would be reduced by $50,000, giving you a net balance, and then that is the number that the lender will use to help qualify you. Okay, so now the two ways that they can do it, depending on the lender, because not all lenders have these types of programs, is there's one lender, for example, that'll take the net balance that we just talked about after deducting any debt on your credit report, and whatever that number is, let's say it came to $400,000 or $450,000, if your purchase price is $400,000 or $450,000 and greater, they'll give you the mortgage. Okay. Now other lenders will take it a step farther and will use a different math equation. So in the example in the article where this video is embedded, let's say your liquid assets are $600,000, your net liquid assets. They'll divide your total by 60. So now we have $10,000. So that $10,000 is the income base that they're going to use on your loan application for your monthly income. And then from there, it goes through the DTI calculation just like any other mortgage would. Okay, so those are two ways that it can work. Okay, so now the other thing you need to know is that the interest rates and the qualifications are going to be different than what you might find with a conventional loan. So these are special portfolio lenders that offer these types of programs, and there are not many of them. You're not going to have an interest rate that's remotely close to a conventional loan. It's going to be a few points higher. Okay, the credit score requirements will likely be different. Your down payment's going to be higher, possibly 15, 20, 25%, depending on your credit score. You might, though, be able to qualify with a recent bankruptcy or foreclosure, because again, these loans do not have to meet Fannie Mae or Freddie Mac requirements. And you might be able to get them for large amounts too. $2, $3, $4, $5 million loans are not unheard of for an asset depletion loan. But of course, you need a high level of liquid assets to qualify for a mortgage that high. Okay, so the lenders that offer this, there are some in the industry, but the industry is changing, and some lenders are removing this as part of their product offering. So the best bet is to just give us a call at Dream Home Financing, or just fill out the request quote form, and we'll look at your scenario and be able to pair you with a lender who will be able to help you with an asset-based mortgage or an asset depletion loan. Hopefully that helps. If you have any questions, just let us know, and we'll get back to you pretty quickly. Thanks for watching, and have a great day.